Right, so I'm going to show you one of my favorite little known tax secrets that there is out there. And it happens to have something to do with reverse mortgages, believe it or not. If you haven't updated yourself on your understanding of reverse mortgages, they're probably way better than you think they are. Give them another shot, update your understanding, talk to a reverse mortgage loan officer. I happen to be one of those too. But I mostly spend most of my time doing in the tax space as a CPA. So let me just kind of show you what I mean by this. Okay, so let's say you have a traditional IRA, okay? And as you know, you put money into those pre-tax, but when you take the money out, that's when it's taxed, right? So let's say you have $100,000 in your traditional IRA, and you want to put that $100,000 into your bank account. Well, what happens with that, of course, anytime you take money out of a traditional IRA, here comes a 1099-R. Now, I have a 27% marginal tax rate. That's a 22% rate plus a 5% state rate is the net tax effect on that. I'm going to assume here, okay? So that 1099-R comes and it slashes your $100,000 into $73,000. Ouch, that hurts. Is there a way we can avoid that? That would be great legally, right? So, of course, there is. So, let's talk now about doing some tax planning. And let's say you got a home equity conversion mortgage, which is FHA's version of reverse mortgages, and you let it accrue $100,000 worth of interest. Now, that's going to depend on the loan balance. This is particularly common with somebody who did a HECM for purchase. You can buy a home with a reverse mortgage. It's pretty cool. 60% down, roughly 60 to 65. It depends on how old you are, but you can do a 60 to 65% down payment and never have to make a monthly mortgage payment, as long as you're playing by the other rules. Okay. So let's say you build up $100,000 of accrued interest in your HECM. And so great. So let's pay that accrued interest. So you're still going to get that 1099, which is going to have that $27,000 tax bill attached to it. But you're going to get, since you paid interest, you're going to get this form 1098, which is mortgage interest deduction. You have those on standard mortgages all the time because you make those payments every year. If you've got a mortgage, you'll get that form in the mail. Same thing with a reverse mortgage when you pay it. And you can choose when you pay it. You can let this stack up over 3, 4, 5, 6, 7, 8 years, depending on how much the loan balance and the interest rate of that mortgage is. But let's say you do that, you pay the $100,000, you get this 1098, which is going to offset that 1099, meaning you get to keep the entire $100,000. But Dan, you paid the interest. How do you get it back out? Well, a HECM or a home equity conversion mortgage, reverse mortgage, is an open line of credit. So you can put money in, you can take money out. Now, this is a maneuver I'm going to do with my parents probably 3 times or so. Depending on how long they live. It could be longer than that, right? And I'm going to save them. Gosh, I'm going to do this how many times? And each time I'm going to save them like 27 grand in taxes, something like that. Pretty freaking significant kind of savings there. And it doesn't have to be an IRA. It could be a capital gain. You sell a bunch of stocks. You could lower that tax. There's a way to do that. It could be maybe you sell a business or something like that, and you can use this. Is not just a tool for the poor and the desperate. It is a very, very effective tool for middle and upper middle class to really mitigate some of these tax risks. As that 1098, like I said, will cancel out that 1099, meaning you got that entire $100,000 out of your traditional IRA tax free. Freaking great, isn't it? So there we go. It disappears. And that's how that works. So if you have any questions on that, please feel free to let me know. I would love to help you out. And thanks for watching.